Naman I was aiming talaga for ano, for the tax prep, not for the
Uh-huh.
bookkeeping na internship. Kaya sabi ko, try ko lang ano,
Okay.
sumali sa exam kasi para ma-experience ko.
But it was pretty nice, right? Pretty nice
Yes,
experience.
oo, ang ganda, ang saya. Yung adrenaline mo, yung ano, ang saya-saya lang ano, makikipag-compete sa mga bata-bata.
Exactly. Yeah, I'm so excited. Kagabi nag-ano na kami, nag-start. I mean, some of you guys join us sa stream, di ba? Start na kaming mag-orient and I'm excited for the 10 people na the pioneering batch ng internship. Magagaling lahat. And then we're skipping the meeting today kasi may meeting ako with Kendall at 9. But I already sent some materials that they can preview. Maybe I will do live stream, maybe mga 11 siguro if you guys are up for it. But yeah, hopefully matapos kayo ng Saturday and you guys can take the certification. Tapos sabay-sabay kayong mag-share ng mga ano, mga certificate niyo sa page or sa community. Diba? That would
Exciting.
be so fun. It would seem nice. And then I'll see you guys Sunday. So we're still looking. I'm still waiting on Zara to come up with promotional materials para dun sa Sunday overview. Hopefully you guys would share it. Yung may mga TikTok accounts dito, if you guys can actively share our contents. Kasi I realize dalawa sa top 10 na interns, they found us through TikTok. Right? So, ang TikTok natin na Borderless Accountant, ano lang tayo, 1,000 plus pa lang tayo na followers. Tapos, parang a month ago lang ata namin, less than a month pa nga eh. Less than a month pa yun namin na talagang pinut together. Kasi merong iba na nagsishare talaga. Like si Noreen, for example, active siyang nagsishare. So ayun, yung dalawa na nakita niya tayo doon sa TikTok. Yung dalawa naman, si ala, si RM ata. At saka si uh, sa Facebook naman sila. Tapos yung iba referral na. So it really matters, no? Si Raymart pala. Raymart, found us on Facebook. Saka si RM. So, you guys, if you have active TikTok accounts or Facebook, if you can share materials, like yung iba ginagawa nila sa TikTok, they like take a video of themselves like watching the materials and then they post it. Yun, maraming nagko-comment, maraming na nakikita nila tayo doon. And it's good, right? Um, Kasi goal natin is we reached yung talagang magagaling. Kasi kung kung ang mga magagaling ay ginaid natin at binigyan natin ng structure, mabilis silang mag-grow, right? Mabilis silang makakuha ng client, mabilis silang mag-expand, and then eventually they would help you guys either work with them, work for them, or pwede nyo sila din maging mentor or coach, right? Especially if you are in the same team, right? So, ganon. When we share, we don't know na yung pag-share natin actually is also could actually help us back in return. Right? So, yun lang naman yung sa akin. 7:06 na. Who's leading today? Because I will have a meeting with Andrew kasi after this. So
Si Arnold.
I'm
okay.
gonna be the one to share the
Sige.
QBO.
Take the floor and then mag-exit muna ako ha. See you guys
Okay.
soon.
See you. Nag-prayer na ba?
Hindi pa.
Who wants to lead? Any volunteer? $14.9. Pabuti natin ng 50. Dalawa na lang.
Dalawa na lang, 50 na. Anong tawag nito? You need help po ba, Arlo, for the QBO? I can share naman kung gusto mo.
Ikaw na lang mag-share.
Yes po, I can navigate for you.
Kasi iniisip
Para
ko,
sa sound.
kumukulog. Hindi, meron akong chinek sa audio. Hindi ko lang alam
Mhm.
kung gagana siya. Try nga natin. Pag wala, ikaw na lang. Ah,
Sige po,
ah,
just let me know po if you need help.
share sound. Hindi, siguro nga ikaw na lang mag-share. Kinakabahan ako sa weather dito eh. Kumukulog kasi. Baka biglang
Okay, sige.
mawala. Sayang.
Ako na mag-share
Ah, ba
ngayon.
yan? Ikaw ang... ako bang ginawang host?
Analyzing. Ano na nga ba tayo? Analyzing. Pero sige, wait lang. Share muna
Sige.
ako. Share pizza. Wait ko lang ang approval ng sharing.
So, may ano yata, AR, turnover.
Oo, alam ko mag-e-ento eh. Kasi sinundan ko naman yung, ito, 338 na tayo, di ba?
Mm.
Comparative income statement na tayo.
Ang alam ko, ang huling question natin is AR uh, something.
Yes, ang huling question is, wait lang ha.
What is the accounts receivable turnover?
Yes, yung answer is, what is the debt asset ratio?
Before yan,
Accounts payable
mga
turnover ratio na tayo.
mga dalawang question pa,
Total
tatlo.
liabilities.
Yung sinundan yan.
Yung sinundan nun?
Mm. Nasa last part na kasi yun eh. Biglang nag-9 na nga.
Wait lang ha, check ko. Decrease.
Yan, kay Elsa, malapit na yan. Ay, hindi. Sige pa. Up pa.
Gross profit margin, tapos na tayo dito, di ba?
Hindi pa.
Profitability. Income statement ratio, di ba? Tapos na tayo nito.
Ang ano kasi, ang natapos natin
Asset pala,
question,
balance sheet pala yun.
accounts payable, tsaka
Tayo turnover. Accounts
yung
payable.
na pending na question about accounts receivable ratio.
See, so baka dito tayo.
Yan,
Balance sheet
pababa dyan.
metrics. Three to five. Sagot natin dito. Ito, current ratio.
AR turnover.
Cash ratio. Let's check. Ito, accounts receivable.
Yan.
Tapos yung edit ng question nito. Yan.
Hindi, yung question mismo
So,
na yun.
ito. Na
Yan,
let's check tayo.
dyan tayo.
So, dito tayo start to try it out.
So, I guess we should start by praying. Let us put ourselves in the presence of the Lord. In the name of the Father, Son, Holy Spirit. Amen. God, Father, thank you for allowing us to meet again for this wonderful endeavor. Thank you for bringing us together in this community as we try and learn QBO all at the same time. Give us the wisdom to understand everything, the spirit of knowledge to guide us on every learnings that we will about to uh, absorb today. And as a special prayer, please keep the people in Cebu as well as the people in Batangas, Laguna, and anywhere in the Philippines that is having problems with uh, the storm and the natural calamities. Please keep them safe. All this we ask in the name of Jesus, who is our Lord and Savior forever and ever. Amen.
Amen.
In the Father, Son, Holy Spirit. Amen. Okay, so yung debating question or the question that was pending yesterday was about the accounts receivable turnover ratio. So says here to calculate the accounts receivable ratio, Yolanda's owns a yogurt making business that had a total of $60,000 in credit sales this year. Credit sales meaning collectible siya, AR. Use the following balance sheet to calculate the accounts receivable turnover ratio. So January 1 beginning balance niya ay 5,000 and then at the end of the period receivable ay 7,000. So what we do is we add the two balances that gives us 12,000. You divide by 2, the average receivable of the receivable is 12. I mean 6. 12 divided by 6. And then if you remember so given ay 60,000. Should I try to speak in English ELP? This is recorded, right?
Yeah, this is recorded.
Okay, I'll try. So 60,000 is the sales over the average receivable, which is 6. That should give us 10. And that will be, if you can scroll to the answer, letter B. Please submit. Yes, the accounts receivable turnover ratio is calculated by dividing the net credit sales, which is 60,000, and by the average accounts, bakit payable to, receivable, which is 6,000. This results in a ratio of 10. So according to Yolanda's balance sheet, the accounts receivable on January 1 was 5,000, and on December 31, the accounts payable was 7,000. Yolanda's average accounts receivable for the year was 6,000. This is calculated by adding the beginning and ending accounts receivable balances and dividing by 2. So based on the formula, Yolanda's accounts receivable turnover ratio is 10. And that's how they calculate it. Now the next is balance sheet metrics, solvency. Now let's look at the solvency metrics from the balance sheet. The first is debt to equity ratio, and we're gonna play the video.
When we talk about the debt to equity ratio, there's a few pieces that need to be defined. First, Debt is money that a company owes to others. Equity is the amount of money that is invested in the company by the owners. With the debt to equity ratio, we are finding out the percentage of debt versus equity in the business. In other words, how much debt did the owner take on to run their business? To calculate the debt to equity ratio, divide the total liability by the shareholders or owners' equity. This can also be called a leverage ratio because when a company has a lot of debt, they're considered to be highly leveraged, meaning they're on the hook for a lot of debt if things go downhill. Being highly leveraged is not always a bad thing. Many businesses operate that way. But of course, there needs to be the income and the money coming in to make sure that that debt can be paid. And honestly, when you look at the ratio, you won't necessarily be able to say this is good or bad, or this is too high or too low. It really depends on the industry, the business's history, the experience of the owners, and so on. In some circles, they will say that if a business doesn't have enough debt, then that means that too much of the equity is being used to finance the business. Some might say the opposite is true, where too much debt being used to finance the business is a bad thing. There's lots of different ways to fund growth and to fund operations in a business. Using the debt to equity ratio and looking at trends really gives your client an idea of if they're going in the right direction for their business goals.
Is Joel here?
Uh, Hello, good evening.
Yeah, Joel. If you can read,
Yeah,
please.
good. Yeah, is my audio okay? Or
Yes po.
Yeah, we can hear you.
okay? Please bear with the weather because signal is unstable. Okay. Solvency, debt to equity ratio. This ratio compares total debt to total equity. It is a good indicator for banks and lenders to see how much risk an owner is bearing versus external creditors. Debt to equity ratio equals total liabilities or debt over total equity. What does the debt to equity ratio mean? Debt to equity ratios vary from industry to industry. Different norms or standards have developed for different industries, so it's important to compare the debt to equity ratio of the business you're working with to those of businesses in the same industry or sector. Generally speaking, a debt to equity ratio below 1 will be uh, seen as relatively safe, whereas ratios of 2 or higher would be considered risky. Try it out. Calculate the debt to equity ratio. Uh, Sven owns a chocolate shop and contributed $200,000 to get the business started. Use the following balance sheet to calculate the debt to equity ratio. Balance sheet assets. There's cash of 25,000, inventory 25,000, current assets 50,000, fixed assets 270,000, total of 320,000, and there's accounts payable 30,000, loans payable of 100,000, owner's equity, Sven capital 200,000, total liabilities and owner's equity 320,000. Arnold.
Wala ata si Arnold. Sige po, tuloy mo na lang po,
What is
Joel.
the debt?
Sorry, nakamute.
Diba?
eh,
What is the debt to equity ratio for Sven's chocolate shop? 0.375. Letter B is 2.67. 0.6, letter C, and letter D, 0.1. Most of you answer C. and it is C. So again, the formula is dividing the total debts, which is 120, by the total owner's equity. Result is zero point 0.6, and that's the formula. Joel?
Uh, okay, select the card to read
Uh,
the other side.
show the cards, Mary Chris.
So if the debt to equity ratio is too high, it is signal that the business may not be able to pay its debtors. That's not a good position to be in. The other card, too low. If the debt to equity ratio is too low, it could indicate that the business is relying too much on equity to finance the business. That could be costly and inefficient. Some small businesses tend to shy away from higher levels of debt, but using debt can be an efficient way to grow a business. For example, if the earnings that the borrowed money generates are higher than the cost of borrowing it. Knowledge check. Use the following table to answer the questions. Liabilities and owner's equity. Current liabilities, accounts payable, 1800 dollars. Total current liabilities of 1800. Long-term liabilities, there's blank, no notes payable, 8800. Total long-term liabilities, 8800. Owner's equity, owner's investment, 5000. Owner's draw, negative 450. Total owner's equity, 4550. Total liabilities and owner's equity, 15,150. Arnold?
Yeah, what is the debt to equity ratio? 2.33 for letter A, B is 1.93, C is 0.7, D is 2.12. The answer should be A. Again, using the same formula, you divide the total liabilities by the total owner's equity. That should give you 2.33 debt to equity ratio. Would this business be considered safe or risky? They should be risky because it's too high. So a ratio of 2.0 or higher would be considered risky. This business would be classified as risky. On the safe option, it will be incorrect. In general, a debt to equity ratio below 1 is seen as relatively safe. With a ratio 2.33, this business does not fall in that category. Joel?
Yeah. Okay, it's risky. That means it's because the debt is higher than the equity. So debt to asset ratio. Debt to asset ratio equals total liabilities over total assets. Solvency. Debt to asset ratio. So that's solvency. This ratio shows the percentage of a business assets that are financed by creditors. What does the debt to asset ratio mean? A debt to asset ratio of zero point 0.7 means that for every dollar in assets a business owns, it has zero point 0.7 dollar in debt and is in a good financial health. Generally speaking, a debt to asset ratio below 1 is seen as relatively safe. So below 1 is safe. Whereas ratios of 2.0 or higher is considered risky, although it depends upon the industry. Now let's check.
Okay, so for the knowledge checks, use the following table to answer the questions. The total assets is $170,000. Cash, current asset is 50. Uh, debt to asset. Accounts payable is 20. Loan payable is 100. So total is 120. Let's go to the question. What is the debt to asset ratio? A 2.33, B 1.93, C 0.7, and then D 2.12. That should give us C 0.7. So again, dividing the total liabilities, 120 by the total assets. A high debt to assets ratio in, oops, sorry. So basically what that means is the assets covered the total liabilities just in case the business will decide to cease operation or stop operations. They have all the assets needed to satisfy all their debtors. There's no there's no need to go after the owner's equity. The assets can cover it.
Okay. Comparative income statement analysis. Comparison helps with interpreting the data. Two types of comparative analysis. There are two primary types of comparative analysis that are performed by bookkeepers: horizontal analysis and vertical analysis. Select the card to read the other side. Horizontal analysis, also called trend analysis, allows for determining trends over time. For example, seasonal sales trends. Vertical analysis helps dig into what percentage of line items are helping or hurting the business financials the most within a single point of time. We'll be looking at both, but let's start with horizontal analysis. Horizontal analysis, bookkeepers are often asked to analyze the performance of a business over a specific period of time. A good way to do this is with horizontal analysis of the income statement. Horizontal analysis, also known as trend analysis, involves comparing financial data of a business over multiple periods, such as years or quarters. The purpose of this analysis is to identify trends, patterns, and changes in the financial performance of a business. This can help you evaluate its growth, stability, and overall financial health. There are two common methods used in horizontal analysis: dollar amount and percentage analysis. Select the plus icons. Dollar amount analysis. Dollar amount analysis involves comparing actual dollar values of statement items over time. For instance, you can compare a business total revenue over several years. By examining the changes in dollar amounts, you can spot growth or decline in specific line items. Percentage analysis calculates the percentage change between two periods, helping you understand the growth or decline rate of various financial statement items like revenue, expenses, or net income over time. Remember, horizontal analysis is not enough to fully understand a business's financial health. It's crucial to combine it with other financial analysis techniques and consider qualitative factors to make informed decisions. Percent change formula.
Joel, excuse
Oh,
mo na, mahina daw yung boses mo.
ay, mahina ba?
Okay, let me Am I,
Sige, please go ahead, Arnold.
oh, okay, okay. Sure. Yan, okay na.
Okay na ba?
Yeah, mas malakas yan.
Okay, percent change formula. This is used to calculate percentage difference between two time periods, especially in trend analysis. Dollar value recent period. Percent change equals dollar value older period over dollar value over value of older year times 100. Let's look at an example. Using the following income statement, calculate the percent change of net sales between the 2 years. Arnold, please go ahead.
Yeah, let's look at an example. So we had 2021 and 2022. Uh, it's covering net sales, cost of sales, gross margin, total operating expenses, and net income. Let's see what the question is. To calculate the percent change, subtract the net sales value of the older year from the net sales value of the most recent. So from 2021 minus 2022, older to recent. Then divide the result by the net sales value of the older year. To older would be 2021, $250, $639. So if you do that, it will give us 0.063. If we multiply that by 100, it will give us the percentage change of 6.3%.
6.3 higher than the previous.
Yeah. Calculate. Is that the question? Calculate the percent change. An e-learning training business took on a big project last year. They landed a deal with a major airline to revamp all their employee training. As a result, they had to increase staffing to handle the load. Look at their income statement and determine what the percent change was between last year and the year prior. So net sales is $639,487, and if we so if we deduct the current year or the 22 year of 854, and then whatever is the outcome, you will divide it with the 2021 net sales figure. That will give us the percentage change, and that should see the percent change is calculated by, yeah, using the same formula. Net sales of the previous or older, you take it you take the current or the most recent year and then divide by the uh, prior year, and so we have a percentage of 34% on this question. Next slide, please. What is the percent change in net income for the business? So if we go back to the, yeah, so net income $196,350 on 2021. We subtract $143,161 for 2022, and then divide it with the 2021 net income. That would be the change. In this case, net income is a decrease. So if we have this type of question, we are sure that's going to be a decrease, right? So it's going to be negative. And then the four options will offer two negatives and two positives. So in answering, we will already take out B and C. So it's leave us with A and D. And this one, the answer is D. That's right. The percent change is calculated by subtracting, yeah, same formula, prior year less the current or recent year over the prior year's income. That will give us the change. In this case, the net income decrease, so it's going to be a negative percentage of the 27%. Next. What could explain the decrease in net income? A. An increase in operating cost. B. Higher tax rates. C. Decrease in operating costs. And D. Increase in net sales.
So that's it. Okay.
Look at the operating expenses. It was 408,000 plus. It goes up to 679. So that should explain the decrease in net income, which is letter A. Remember, the horizontal analysis alone does not provide a complete picture of a business financial health. It should be used in conjunction with other financial analysis techniques and qualitative factors to make well-informed decisions. Joel?
Okay. Vertical analysis. Vertical analysis involves proportionally analyzing a financial statement at a specific point in time. In this analysis, each line of the income statement is expressed as a percentage of the base amount. Vertic On an income statement, the base amount is the gross sales or revenue. Vertical analysis provides some key benefits to bookkeepers. Let's look at those now. Select the plus icons to open the Learn More. Uh, Keeps it simple. Vertical analysis simplifies financial statements by representing individual items as percentages, making it easier to understand the relationships between different elements. Helps set goals or limits. Vertical analysis is helpful for business owners and managers because it allows them to set percentage goals or limits. For instance, if gross profits fall below a specific threshold, a business may decide to discontinue a certain item. Provides uses provide provides uses metrics. Vertical analysis offers valuable metrics to compare businesses within the same industry, especially when they operate at different sizes or scales.
Hindi po, Joel. Mahina na daw po ulit yung boses ko po.
Ay, mahina ulit. Ito.
Ayan po, okay na po.
Okay, knowledge check. Arnold, go ahead.
Okay. Which analysis reveals the percentage of line items that have the most significant impact, whether positive or negative, on the business financials? A. Horizontal, B. Vertical, C. Percentage change, and D. Dollar amount. And the answer should be B. Vertical. Remember, with the two types of horizontal and vertical. Horizontal, it's asking or telling you about trends over some periods of time. So just not a single period. Periods. It trends of trending. It's a trend analysis. While vertical, it's just one uh, specific period.
Mm.
Next,
Okay. Mag-add-ons ako ha.
go ahead.
Vertical and horizontal. Ang horizontal, mostly ginagawa siya as guide 'pag nagba-budgeting kayo. Kasi over period of time yung ano niya, comparison. 'Pag
Tama.
vertical naman, 'pag nagma-monthly review kayo ng P&L, they usually use the vertical kasi tinitingnan nila kung magkano yung percentage or yung performance mo for that particular period.
Correct. Okay, next slide, please. Elsa's plumbing business showed a gross profit in this year of 165,000, and for last year it was 223,000. What is the percent change from this year to last year? So going back to the formula, last year 223 less current the current year of 165, and then divide by 223 again. That should give us D, because the profit decreases. So it should be negative answer, and the only negative answers are A and D. But the answer is D. Yeah, that's the formula now we used. Last year last year or over the older year less the oh, no, wala yun siya. Yeah, last older year from the value of the recent year, dividing the total by the value of the older year, and then multiply 100 by 100 to get the percentage. Next slide. Joel.
Income statement ratios, tracking profitability. In addition to measuring liquidity, efficiency, and solvency, bookkeepers also should be tracking profitability. By the way, thank you, Mary Chris, for the add-ons regarding the application of horizontal and vertical analysis. Thank you. Let's move on. Profitability, measure of financial gain, what percentage of revenue is retained as profit, the difference between money earned and money spent. How to assess profitability? One way to assess profitability is to create calculations of profit margins using the information found on the income statement. There are several iterations of this, but they all follow the same basic premise. That is, divide some sort of profitability metric by sales revenue. Gross profit margin, the measure of a business profitability. Operating profit margin, the measure of how much a business makes on a dollar after paying for expenses and overhead, but before paying interest or tax. Net profit margin, the measure of the percentage of profit a business produces from its total revenue. Gross profit margin measures the percentage of revenue a business retains after deducting the cost of goods sold, COGS. It reveals how effectively a business generates profits from its core operations. It can also be used for comparison with other similar types of businesses. The gross profit margin indicates if the business needs to lower its COGS or raise prices to stay competitive. The determination of what is considered a good profit margin varies by industry and business, but let's look at some general guidelines for what a higher or lower gross profit margin could indicate. Select the cards. A higher gross profit margin means the business is doing a good job controlling production costs and earning more profit per sale. It shows efficiency in production and the ability to charge higher prices or manage costs well. A lower gross profit margin suggests the business might be having difficulties controlling production costs or facing competition with lower prices. It could also mean there are inefficiencies in the supply chain or higher input costs. Gross profit margin is financial metric that helps evaluate a business profitability and efficiency in generating profit from its core operations. It gives valuable information about cost management, pricing power, and competitive strength. Gross profit margin equals gross profit sales revenue less the COGS over sales revenue. So gross profit margin shows the percentage of revenue that exceeds the COGS. What does the gross profit margin mean? Gross profit margin. In industries with higher production costs or where competition is intense, a good gross profit margin might be in the range of 40% to 60%. On the other hand, industries with lower production costs or specialized products might have higher gross profit margins, possibly exceeding 70%. Although gross profit margin is important, it has limitations. It doesn't include other operating expenses like selling and administrative costs, so it only gives a partial view of overall profitability. Also, comparing gross profit margins between industries may not be meaningful due to differences in business models and cost structures. Try it out. Calculate the gross profit margin. Jamie's Jewelry Store had a total revenue of $10,000 during the past month. Use the following income statement to calculate the gross profit margin. Arnold?
Yes, so gross profit, uh, total revenue is 10,000. Cost of goods sold is 3.5, so the gross profit is $6,500. And $6,500, that's the gross profit margin over sales of 10,000 is 65% or 0.65. That's A. So again, the formula is gross profit margin subtracting the cost of goods sold and then over the total sales. Answer is 0.65. We are trying to get the percentage, multiply it by 100. That gives us 65%.
Operating profit margin. Operating profit margin measures how much profit a business makes on a dollar after paying for expenses and overhead, such as wages and raw materials, but before paying interest or taxes. So the formula, operating profit margin equals operating earnings before taxes over sales revenue. What does the operating profit margin mean? A higher profit margin indicates that the company is effectively managing its operating costs and generating stronger profits from its primary operations. A good operating profit margin varies widely depending on the industry, business size, and economic conditions. For instance, smaller businesses might have higher operating profit margins compared to larger corporations due to reduced overhead and more focused operations. Similarly, newer companies might have lower operating margins as they invest heavily in growth. Let's look at few other types of industries. Technology and software industries. Industries that offer high value products or services like the technology and software industry, or those that have relatively lower operating costs, might have higher operating profit margins. In these cases, operating profit margins exceeding 15% or even 20% can be considered good. Retail and manufacturing industries. In competitive industries with tighter profit margins such as retail or certain manufacturing sectors, operating profit margins might be lower, possibly ranging from 5% to 10%. Automotive industries, industries that are sensitive to economic cycles, such as the automotive industry, might experience fluctuating operating profit margins. Businesses in these sectors might be judged based on their ability to manage costs during downturns and capitalize on opportunities during upswings. Let us hear about one bookkeeper's experience with operating profit margins in the following video.
Now, what exactly is the operating profit margin? It is the operating earnings divided by sales revenue. How do we calculate it? First, we need to know the operating earnings. Remember, the business has all these expenses that help keep the doors open and the lights on: utilities, payroll, professional services, dues, and subscriptions. Take all of those types of expenses and subtract them from the gross profit. This gives you the net operating income, or operating earnings. So my client Iris had $1,000 in sales and $300 in operating earnings. Taking our $300 over our $1,000 gives us 0.3, or 30%, as the operating profit margin. It's extremely important to a business that there is some profit like Iris has, so we definitely want to see a positive number for the profit margin. Ideally, clients have established a percentage that they're hoping for in order to meet business needs. As the bookkeeper, you can help your clients see how they can hit their desired operating profit margin by showing them where their profit or expenses are off target. This is something many clients do not understand how to do themselves and are often overwhelmed by it. Helping business owners read financial statements and explaining things in a really simple, clear, relatable way can be so helpful and can honestly change how your clients run their business.
Okay, let's revisit uh, Jamie's Jewelry Store. Review the income statement again and then answer the question. Income, sales revenue of $10,000, total cost of goods sold 3,500, gross profit 6,500, total expenses 2,750, operational earnings 3,750, tax expenses 900, net profit of 2,850. Arnold?
Okay, so what is the profit margin for Jamie's Jewelry Store? A 29%, B 38%, C 35, D 28. When is so JB says 38, B. The answer is B. And that is by dividing the operating earnings before taxes, which is $3,750, by the total sales revenue of 10,000, giving us 0.375, multiplying by 100 to get the percentage rounded up to 38%. Next. Joel.
Net a business can increase the operating profit margin by raising prices, lowering cost of goods sold, lowering operating expenses and overhead. Net profit margin. This formula calculates the percentage of profit a business earns from its total revenue. It shows how much net income the business keeps from each dollar of sales after paying of operating expenses, interest, and taxes. The net profit margin is a crucial measure of a business's overall profitability. Higher profit margins mean more profit is generated from every dollar of sales. Generally, net profit margins above 10% are considered good, but this can vary depending on the industry. So the formula, net profit margin Okay, what does the net profit margin mean? For every dollar that James Jewelry Store generated in sales, the business kept $0.29 as profit. This is calculated by dividing the net profit, 2,850, by the sales revenue of $10,000. A net profit margin above 10% is often considered healthy in many industries, but in some highly competitive sectors, the net profit margin might be lower in the range of 2 to 5%, for instance. Note, in some small businesses, only the owners incur taxes due to the business structure. As a result, the net profit margin and operating profit margin in these cases would be the same. Once more, James Jewel Store, review the income statement again, and then answer the question. Arnold?
Okay. I think this is still the same. Let's go to the question. What is the net profit margin for James Jewelry Store? So net profit is 2,850 over sales. So that's 0.285 or 28.5. Rounded off will be 29, which is letter A. So again, we calculate that net profit, dividing the net profit by the total sales. The answer is 0.285 and then multiply by 100 to get the percentage. And then they run it off to 20 nearest with this 29%. Back to you, Joel.
Question po tayo dito.
Okay.
Anong difference niya po sa operating net profit margin?
Uh, Operating, it's before the taxes. Taxes are not part of operations. So anything that involves the operations, any expenses, you take that into consideration to get to the operating income. So if it's not part of the operations and you pay it, like salaries of the admin, we and the taxes, even the depreciation, we deduct that from the operating income to get the net profit. Does that answer your question? Or can somebody maybe add?
Joby, Joby di Joby was the one questioning. She
Net
said it's
income
okay
after
po.
tax.
Okay naman daw po, sabi ni Joby.
Okay, continue.
Analyzing the statement of cash flows. Calculate a business solvency. When it comes to determining if a business is solvent or insolvent, there are a number of methods that can be used. One of those methods uses the statement of cash flows to calculate the ratios that demonstrate a business solvency. The cash flow coverage ratio shows the amount of cash available to pay interest on a business debt. The statement of cash flows provides valuable insights into the cash inflows and outflows of a business during a specific period. Let's look at what positive and negative cash flows from operations may indicate. Positive cash flows from operations indicate that the business core operations are generating cash, which is good sign of financial health. Negative cash flows from operations suggest that the business is struggling to generate sufficient cash from its day-to-day operations, which is a cause for concern. We can also assess the cash flows from investing activities with a statement of cash flows. Positive cash flows. Positive cash flows from the investing activities may indicate that the business is investing in long-term assets such as new equipment or business expansion, which demonstrates growth potential. Negative cash flow uh, from investing activities may occur when a business is selling assets or divesting from certain operations, which is cause for concern. It is therefore important to analyze the reasons behind these negative cash flows and assess their impact on the business future prospects. We can also assess the cash flows from financing activities. Positive cash flows from financing activities may suggest that the business is raising capital through debt or equity financing. This could be a sign of growth or expansion plans. Negative cash flows from financing activities may indicate that the business is repaying debt or returning capital to shareholders. This can provide insights into the business capital structure and its ability to manage its financial obligations. The state the statement of cash flows is vital tool for analyzing a business liquidity, solvency, and financial health. By studying the cash flows, we can evaluate how well the business generates and manages cash. It's to it's important to analyze the cash flow statement along with other financial statements. Cash flow coverage ratio. The cash flow coverage ratio reveals how much cash a business has to cover its interest expenses on debt. Banks and creditors use the ratio to assess the risk of a business potentially being unable to repay a loan or a line of credit. So the formula cash flow coverage equals cash flow from operations over total debt. What does the cash flow coverage ratio mean? A ratio less than 1 means that there are fewer funds than the amount needed to pay off all liabilities. For a small business, this means it might have to consider refinancing loans or restructuring operations to generate more cash flow. Try it out. Miller owns a business that manufactures mustache wax, which has outstanding debts totaling 38,000. Using the cash flow statement, determine what the cash flow coverage ratio would be. Arnold?
Okay. Uh, Cash receipts from customers is 152,000. Cash paid for inventory is 15. General operating and administrative expenses 10. Wage is 55. Interest is 3,000. Income taxes is 12. So net cash flow from operations is 57. What is the cash flow coverage ratio for Miller's business? Should be a 1.5. And that is by dividing the cash flow from operations, the total, by the total debt, which was given in the beginning, which is 38. So divide that, they have a ratio of 1.5. So that means for every dollar that they owe from somebody, they have $1.50. So that means the liabilities are covered by the cash.
So that means it is safe, not risky. Okay, current liability coverage ratio. The formula, current liability coverage equals net cash from operations over average current liabilities. Also called current cash debt ratio. This ratio looks at the ability of the business to pay its current obligations. This ratio is what investors or potential investors use to judge the liquidity of an entity. It tells them if the entity generates enough cash from its operations to continue the business. What does the current liability coverage ratio mean? Like many of these ratios, the higher the ratio, the better. If the value is a number greater than 1, a business has enough money to pay off current liabilities. A negative number is a possible danger sign that the business is not generating enough cash from operations. Bookkeepers need to investigate further why this is happening in the financial statement notes or in a more subjective analysis like looking at management and practices. Try it out. Kelly's pet grooming business is looking at bringing on new investors. Using the cash flow statement, determine what the current liability coverage ratio would be. Ano?
Yeah, so for the pet grooming business, the cash flow from operating is 50,000. The current liabilities at start of the year is 32. Current liabilities at year end is 17. So we get first the average of the liabilities, and then we we divide the 50,000 by the average, and that should give us B 2.04. So that again means they have $2 for every $1 liability, which is good for the business.
Okay, another
Go
video.
ahead. Go ahead.
Yeah, let's explore cash flow margin ratio and why this metric in the next video.
Let's look at the cash flow margin ratio. The cash flow margin ratio measures the percentage of cash flow generated by a business relative to its total sales revenue. This ratio provides insight into how effectively a business converts its sales into cash flow. This is one of the more important profitability ratios for business owners. The higher the percentage, the more cash is available from sales. An operating cash flow margin above 50% means that the business is officially creating operating cash from its sales. A negative operating cash flow margin is an indication that the business is not making any profit, but rather is losing money. One way a business can improve operating cash flow margin is to collect all accounts receivable in a short period of time. They can do this by putting incentives into play for customers to pay on time.
Cash flow margin ratio. This ratio indicates how well the business converts sales to cash, which is important since cash is required to pay expenses. It requires numbers from two financial statements. Operating cash flow is on the statement of cash flow, while net sales are found on the income statement. Cash flow margin equals operating activity cash flow over net sales. What does the cash flow margin ratio mean? An operating cash flow margin above 50% means that the business is officially creating operating cash from its sales. A negative operating cash flow margin is an indication that the business is not making any profit but rather is losing money. Try it out. A wedding planner had operating activity cash flow for the year of 34,100 and net sales of 54,000.
So cash flow margin, again, we go back to the formula. So we take or we divide 34,100 with the net sales, and that should give us letter D. So 60.631 is the margin ratio. Next slide.
Summary summary activity. Put it all into practice. Job aid infographic. Download.
Somebody's asking for the accounting ratio. That's where you get it. That's the list of ratios we use. But that's okay. So you save it on your file if you want to review the terms.
Okay. Jolin's Essential Oils business. Jolin's Essential Oils business has been making deliveries with her personal vehicle, but it's taking a toll on her car. The business seems like it's doing well. She's been really busy. As a result, she's like to she's like to purchase a delivery vehicle for the business. She comes to you with some questions. I want to buy a delivery vehicle so I don't have to use my own car, but I need to know how the business is doing first. How are we doing?
So the question is, what is she asking about? So he is asking, how are we doing? Basically, with business, are we making profit? So this question is inquiring about profitability, which letter C. Okay, Jeline wants to know how the business is doing in general, so she's asking about profitability. Next, let's take a look at your numbers and we'll see. Let's look at your income statement. We got sales revenue of 15,000, total cost of goods sold is 76, giving us a gross profit of $7,400. The total expenses is 2,750, operational earnings is 4,650, tax expenses is 900, net profit 3,750. What is her net profit margin? So if you go back, net profit is 3,750, and what's the sales? 15,000. So if you divide that, that's 25%, letter A. Continue. Net profit margin, just a review of the formula, net profit over sales revenue. That's the net profit margin. Okay, given your net profit margin of 25%, I'd say you're doing very well. That's great to hear. Do we have enough money to meet our upcoming obligations though? So she's asking about obligation. What is she asking about? Profitability, solvency, efficiency, liquidity. Now that question should be for solvency. Are we solvent? Can we meet our debts or liabilities? So that's the letter B.
Letter B.
Yeah.
Some answer letter D or liquidity. Can you
Liquid.
explain? Yeah.
Liquid. Liquid is liquid. Wala tayo dun sa
Liquid.
slide yun.
The liquid
Marcris?
is your cash and cash equivalent.
If you can easily turn your assets to cash, is that how is it, Marcris? If I understand, if I remember it. or anybody who can share. Okay, let's ask perplexity. Mr. Ken? In finance, equity versus solvency. Okay, sabi ni perplexity, liquidity is about meeting short-term cash needs. Solvency is about surviving long-term.
Quickly an asset can be converted into cash.
What's that?
Charlene Obante.
Quickly asset can be converted into cash.
Yeah, let's say may dumating na parcel, may cash ka ba? Parang ganun lang. Pag meron, liquid ka. Pag wala ka mabayad, hindi ka liquid. Pero kung sabihin, darating na yung bill sa katapusan, may pera kaya? Pag may pera ka sa katapusan, meaning meron kang pera today na pambayad sa katapusan, solvent ka. Gets?
Yes, and it is also said that cash is the most liquid asset.
Yes, of course.
It's Jovi.
Hello.
Yes, Jovi.
Hello. Ano lang, nabasa ko lang din, yung liquidity is to pay down its short term, while the solvency is to pay the
Long term.
long term. So yun lang,
Yes.
short term and long term liabilities lang. Nabasa ko lang din doon sa mismong summary, yung downloadable.
So basically, how we use cash sa business. Okay, that's good. So do we have the money? Is that the next question? Okay, that's good. Do we have the money available to purchase the vehicle outright, or do we need to finance it? So what is she asking about? They're trying to get a new or to purchase something.
Outright money kasi ang kailangan
Outright.
niya. So, ibig sabihin,
So,
short term.
In this case, dumating na yung parcel. May pera ka ba?
Dito na yung papasok sa liquidity.
So Jillian's wondering about the ability to find the funds for purchase. She's asking about the liquidity of the business. Do we have enough cash if we want to pay something for cash, like today? That means they're liquid as of that day. Next slide is, let's take a look at your balance sheet and determine your liquidity. So accounts receivable is 45,808. Cash and cash equivalents is 41,685. Total current asset is 87,493. Accrued liabilities is $52,614. Accounts payable was 20. Total current is 72,614. So what is the current ratio? So 87 and 72, that's over 1. That's about around 1.2. So B. So formula, 87,000 divided by 2072 is 1.2. So the formula, okay, just a review of the formula. We know that already. Continue. Okay, given your current liquidity, you should finance or things would be tight. He's saying, or the bookkeeper is saying that because again the ratio is 1.2, meaning for every dollar that we owe, we only have $1.20. Ang excess lang ay 20 cents. So, paano kung may parcel pa ulit? Hindi nakakasya. So, the bookkeeper said to just get a loan. So, the option is, could we make changes? So, what is she asking about? They're thinking of a loan, financing the item, and business owner says, could we make some changes that help us be better able to afford the loan payments? So looking at the future, if maglo-loan, paano tayo makabayad? So in this case, efficiency. They will take better efforts in collecting, better efforts in selling, anything to help the business pay the loan if they will make the loan. So improvements. I think I have some recommendations that could improve your efficiency given what I see in your books. Show what you know. Question 1. If Amy's aromatherapy business had operating expenses in 22 of 45,000 and in 2020 of 37, what would the percent change be? So older is 2021, 37 minus 45,000. That's $8,000 over 37. And that's letter B, 22. So in that question, you should not take a look at the negative answers. So it's between A and B, but B is the correct one. I think the term I'm using, the term is deduction, something. Question 2. What are you trying to analyze if you use the accounts receivable turnover ratio? Profitability, solvency, efficiency, liquidity. Somebody says C, efficiency. Most of you are C. It is C. Which ratio or metric is used to indicate a business ability to pay immediate creditor demands using its most liquid assets? So we only have to choose between current ratio and cash ratio. But it says immediate. Is it cash or current? So cash ratio. Question 4. Justine's gymnastics school recorded 60,000 in sales revenue and a cost of goods sold of 45,000 on their income statement. What is their gross profit margin? So 60 minus 45, they have 15,000 gross profit over 60. 25%. So if there's a negative, you disregard that answer. Which of the following define vertical? Select all that apply. Proportional analysis of a financial statement with a single. That's vertical. Single period. Can compare multiple periods on categories, so that makes it wrong. Multiple periods. Each line of the income statement is listed as a percentage of the base amount. So it's only talking of one period, one statement. So that's a vertical. Allows for determining trends over time. When you say trends, it's multiple periods, so that's not an answer. Helps determine what percentage of line items are helping or hurting the business's financials the most. So that's also an vertical to ACE. Next, 100. Congratulations, you're one step closer to being a bookkeeper. We go to the summary activity, reconciling accounts, and examining financial statements. Medyo madugo-dugo na to. Joel, you start.
Reconciling accounts and examining financial analysis. Part 4 was about the bookkeeper's role in financial analysis, with topics concerning reconciliation and reconciling accounts, examining financial statements, and analyzing business performance. In the activities that come next, you'll get a chance to use your newly acquired knowledge of these concepts by facing glossary challenges and dealing with realistic situations. The following documents might also come in handy. Reviewing terminology, let's review some of the important terms from Part 4, reconciling accounts and examining financial statements.
Okay, so a figure calculated from the income statement. From the income statement, it's the profit margin. A bank form used to document the money the customer intends to deposit in their bank account. Should be bank deposit. The ledger balance as of a certain date. That is book balance. Ay, hindi pala sila binabigyan ng time mag-answer. Sorry. A relationship between two or more accounting numbers that are taken from the financial statements. So two numbers, same statement. What are they trying to get? They're trying to get, let's see, financial ratios, correct.
Craig, the owner of landscaping business, has made sure his business has good liquidity. Which of the following statements accurately describe liquidity? Select all that apply.
Liquidity is the capacity to pay down current liabilities. Yes. Liquidity measures the ability to pay long-term debt. No, that's solvency. Liquidity is typically expressed as a ratio or percentage. True. Liquidity is typically expressed in a range from poor to great. No, so A and C. In addition to good liquidity, Craig's business can also be said to be solvent. Which of the following statement accurately describes solvency? Solvency is the capacity to pay down current liabilities. No, should be long term. Solvency measures the ability to pay long term debt. That's B. Solvency is typically expressed in range from poor to great. No, that's liquidity. So B. Let's review a few more of the key terms you learned in part 4, Glossary Challenge. A measure of financial gain is profitability. The process of comparing historical financial information over a series of reporting periods, reconciliation, horizontal analysis, vertical analysis, profitability. Which one? Between the two analyses. Should be vertical, I guess.
Most answer A.
Okay. The question 4, the proportional analysis of a financial statement within a single point of time. Single. Vertical. Remember vertical, single, horizontal, multiple. Now it's your turn. In the two scenarios that follows, we take a deep dive into Craig's landscaping business financial statements. Scenario 1, reconciliation, setting the scene. As you know by now, reconciliation is the term we use for comparing transactions and other type of activity against supporting documentation. Working with the client's financial statements, you're likely to come across errors and you must reconcile those errors. It's time to perform your monthly reconciliation for Craig's landscaping business. When reconciling errors, duplicate transactions are more common than transposition errors. To start your reconciliation process, compare Craig's latest bank statement with the register. The register is another way of entering viewing journal entries. It shows balances as well as the individual transactions and can be considered the same as the general ledger. Provided below are the December bank statement and register, as well as a reconciliation example file with both account balances listed together for comparison. Select the files and download them. So if you download, so that's the bank statement and register. And I already checked that. It's clear. The reconciliation is clear naman. So we can just open the third because it's already the reconciliation. So for your reference, for you guys, when you do it, if you open all three files, first one is the bank statement, then the register, and then the third file is the reconciliation of the first two. So for just for this portion of the module, we'll just take a look on the third file.
Wait, may problema ako sa sharing.
Mm.
Hindi ko ma-share yung Excel kasi I need to stop sharing.
Okay, sige. I will.
Wait ha, stop share muna ako. And then I'll reshare the Excel.
Oh, you have it.
Where is the Excel? This one, share. Kita po ba? Nakikita po yung Excel?
Yes
Bank
po.
statement.
Okay.
Statement. Excel siya.
So
bank
that's again,
statement.
that's already the reconciliation. When you open the first two file, yeah, the
Ayan,
first is the bank statement, the second is the register. So the third file is just
comparison.
summary comparison of the two. So if you go to the first question, what do
Okay,
you, in addition to good liquidity, Craig's business can
wait lang. I'll stop my share. Oh, I'll share again. Sorry. I'll
kaya
just
ba ano
share again.
to split screen?
Yes po. Wait lang.
Okay.
Hmm, oh, nakikita ba?
Nakatakip yung
Yeah, wait lang ha. Anong so, two screens, di ba?
yan yung
Okay.
question. So what do you compare first? Compare beginning and ending account balances, compare outgoing and incoming funds, compare each transaction. So you're reconciling, you check first if they are balanced, beginning and ending. So that's letter A.
So what do you
Next
notice?
question. What do you notice about the beginning and ending account balances? A, the ending account balances are different. B, the beginning balances are different. C, the beginning and ending account balances are the same. Answers should be A. The account, that's obvious. The ending account balances are different. Next. Something is off. Red alert. First of all, it's best to assume there is an error somewhere and that it might be yours rather than your client's. Time to dig in deeper. Next. Your next step is to compare transactions line by line. What is the error? A. There is a duplicate transaction. B. There is a transposition error. C. There is an outstanding check. There is a duplicate transaction. If you can go back to the answer so that everybody can. The $250.
Uh, the bank statement.
They entered it on December 27. This is on the register. They enter one on December 27 and then it appeared again on December 29. Okay. Mistakes happen. Wait. But you figured it out. In this case, you, as Craig's bookkeeper, entered 250 when he made the online payment. Then you inadvertently added the transaction again. Last row in the register. When it came through the bank feed, if you remove the duplicate transactions, the balances match and the accounts reconcile correctly. So what happened is the owner made a payment online, they recorded it, and then probably when the bookkeeper is checking the bank statement, he saw the charge and recorded again. That causes the error. Scenario 2, analyzing business health. Craig calls to check in. It's the beginning of a new year and I've been wondering about the general health of my business. Do you have some kind of metric for that kind of thing? Absolutely, happy to help. As you learn, you definitely have tools at your disposal to get Craig an answer. Using an income statement and balance sheet, we can calculate ratios for a business and provide Craig with data on the business health based on the metrics found. Calculating the current ratio. The first ratio we want to calculate is the current ratio. Remember what you learned about current ratio? That's current assets over liabilities. What does it show? The current ratio analyzes short-term financial risk and shows liquidity. B. The current ratio analyzes long-term financial risk and shows solvency. C. The current ratio analyzes short-term financial risk and shows solvency. And D. The current ratio analyzes long-term financial risk and shows liquidity. Everyone?
The answer A, all of them. That's right. The current ratio analyzes short-term financial risks and shows liquidity.
Next, what record do you consult for the current ratio and what formula do you use? A. The formula of current ratio is total liabilities and divided by equity. So no. So we're looking at current asset and liabilities, and that is C. So for this question, you really have to memorize those formulas earlier. Okay, for that question, we have to get to the balance sheet to check what is Craig's current ratio. Do we have a file?
Mag-share na nga lang ako ng entire screen ko.
Hello?
Yes, wait lang. Entire screen share. Okay, can you see?
So
Yes.
current liabilities, current assets, $17,712.27. Current liabilities, other current liabilities, over total is 10,000. So 17 over 10. B.
I was asking. This one.
So again, 17 yung asset niya, 10 lang yung liabilities niya.
1.70.
What does the current ratio of 1.70 tell us about the health of Craig's business? A. This is a bad ratio, indicating current assets are greater than current liabilities. B. This is a good ratio, indicating current liabilities are greater than current assets. C. This is a good ratio, indicating current assets are greater than the current liabilities. So C. Yung B kasi baliktad. Tuloy ko na, Joel.
Calculating debt to equity.
Calculating debt to equity. 1 down, 2 to go. The second ratio we want to calculate is the debt to equity ratio. Remember what you learned about debt to equity? So we're talking about liability and equity here. Next slide. What does the debt to equity ratio analyze and what does it show? The debt to equity ratio analyzes long-term financial risk and shows solvency. The debt to equity ratio analyzes short-term financial risk and shows solvency. C is total debt to total equity and shows how risky is a business would be to issue a loan to. And third is compares total debt to total equity and shows liquidity. Answer should be C. Next question. What record do you consult the debt for the debt to equity ratio and what formula do you use? The formula for the debt to equity ratio is total liabilities divided by total equity, which you get from a balance sheet. The formula for the debt to equity ratio is gross profit divided by total sales revenue. That's wrong. The formula for the debt to equity ratio is current assets divided by current liabilities, which you got from the balance sheet. We're not talking about current assets, so it should be A. Hmm? Yeah, A. What is Craig's debt to equity ratio? We go back to the balance sheet. Liabilities and equity.
Ano yung question? What is
A
Craig's debt to
is
equity ratio?
0.37, B is 1.05, and C is 0.74. Answer should be C. Yes, so
19,795
total
over
liabilities over total
26.
equity.
So that is ito, 19,795
19,000.
over ano yun, magkano yun? 26, total equity.
And equity is 26.
26,705.
Okay. What does a debt to equity ratio of 0.74 tell us about the health of Craig's business? A. This is a bad ratio because it's under 2, which points to a highly. This is a good ratio because it's over 0.5, indicating current liabilities are greater than current assets. So that's wrong because it mentioned current assets. This is a good ratio because it is under 2, which is considered to be not highly leveraged or risky. Answer should be C. Yeah, because this value is under 2, it is not considered highly leveraged or risky.
Calculating gross profit margin. One more.
851. So, okay.
The third ratio you want to calculate is the gross profit margin. Remember what you learned about the gross profit margin.
What does the gross profit margin analyze? What does that show? A. Gross profit margin analyzes short-term financial risk. It shows the percentage of liabilities that exceeds assets. Gross profit margin is a measure of business profitability, shows solvency. Letter C is the gross profit margin analyzes long-term financial risk and shows liquidity. And this gross profit margin measure of business profitability. It shows the percentage of revenue that exceeds the cost of goods sold. So the A and C option you should not think about that at all. It should be between B and D.
Let's
D.
see. Hindi ka po naka-mute. Okay.
That's the formula. What record do you consult for the gross profit margin? And what formula do you use? So
Income
record
statement.
is the income statement. So if you see balance sheet, you don't read that anymore. So look at letter A at the end, which you get from a balance sheet. So that should not be your answer. Letter B, the formula for gross margin is gross profit divided by total revenue, which you get from an income statement. Yep, that actually is the answer. Let's try and look at letter C. The formula of gross margin is current assets. No, that's wrong already. The formula for gross margin is net profit divided by total. No, net profit. We're talking about gross profit margin. So B is the correct answer. Great job! The gross profit margin measures business profitability. It shows the percentage of revenue that exceeds the cost of goods sold. It will indicate if the business needs to lower their cost of goods sold or raise prices to stay competitive. We use an income statement or P&L to calculate the gross profit margin. For the next question, do we have enough time? 7 minutes. Are there going to be any announcement, Kelly?
Hi,
We
boss
might be
Arnold.
taking time from the tax class.
Are you all done, boss Arnold?
Should we
It's
continue? Okay.
almost na 'to. Almost na 'to, 'di ba?
Okay.
Malapit na 'to
Gross profit
matapos.
margin.
Gross
Mhm.
profit margin creates business.
I
Okay.
was not able.
So the gross
So
profit here
cost of goods sold, gross
is
profit
13.
13,000, and sales is 13. So one something. Oh, almost one.
Oh, 0.9
So
minus
96.
1. Ay, tama ba?
Yeah, letter A.
0.96.
Gross margin is slightly more complicated than the other two ratios we've looked at here. You divide gross profit by total revenue from sales and service, which is given in this P&L, and then total revenue. Gross profit is a result. Okay, that's the formula. There are two ways to get to the same thing. What does the gross profit margin of 0.96 tell us about Craig's business?
Good.
A. This is a poor gross profit margin indicating revenue is low compared to COGS. B. This is a good gross profit margin indicating revenue to greater than COGS. The margin indicates that 96% of the total revenue came from gross profit rather than cost of goods sold. Revenue is greater, so B. Oh, is it C? The margin indicates that 96% of the total revenue come from gross profit. Yeah.
Great work.
Great work. You call Craig back with your findings. He's pleased to hear about the data you provided him about the health of his business. Craig is appreciative and entirely impressed. You are on your way to being a great bookkeeper.
Conclusion.
Conclusion. Congratulations. You're one step closer to being a bookkeeper. Clap, clap, clap. It's 8:56.
Thank you. Time for some
Admin or
announcements.
Kelly? Do we start the next?
No,
Then,
It's already 4 minutes.
tomorrow na. So will be practice tomorrow and
all
closing.
right.
Who's the host?
May Maybe Arnold. Thank you so much, Arnold,
Are
Joel,
we going
and
to continue?
Maris. Okay.
There's a
Well,
EA or a tax review, right? After.
um, I
And
think
it's
Cherry is here.
8:57.
Do you have EA review now, Cherry?
Hindi ko alam pero parang Hindi kasi ako prepared.
I cannot
Wala akong
hear
tulog.
Cherry.
Ang dami ng ratio. Alam mo sa sa totoong buhay sa management accounting yan eh. Hirap na hirap ako diyan dati.
Ikaw ba,
Nung nag-aaral
Marie-Grace,
ako.
prepared ka ba sa tax review today? Kasi
No.
hindi eh. Kaya nga, walang magsasagot kung di rin tayo review. Baka si Min lang magsagot.
Bukas na lang.
Oo. Okay lang naman. Gusto nyo i-continue na yung
Mag-review muna kami ngayon.
Oo. Or gusto nyo kung i-continue or kung hindi, okay lang
Hindi,
din.
overload na yung management
Overload.
accounting to eh,
Okay. So,
overload.
pwede na
Overload.
relax muna.
Bukas yung yung anong tawag nito, yung continuation natin is practice exam na and closing the books.
All right. Thank you so
Alrighty.
much. A big round of applause for the three reporters.
Hindi, lang ako nagki-navigate lang ako.
My presenter, both Arnold and Joel. Thank you so much everyone din po sa pag-participate.
Thank
Alright.
you.
Ingat po kayo lahat kay
Sana hindi nyo mapanaginipan ng mga ratio ha.
Rachis.
Ang dami eh.
Baka
Pero
mag-compute
useful
kayo sa
yan pag
panaginip.
nagawa kayo ng P&L and then nagre-report kayo, kasama kasi yan sa reporting yung mga percentage. Kasi doon tumitingin diretso sa percentage yung mga yung mga lalo na yung mga owner or yung mga stockholder, doon talaga sila sa percentage. Lalo na yung mga hindi mga into numbers. Titingnan nila diretso percentage. Are we earning? Ganun. So, importante yan, yung mga percentage na yan. Pero usually, pag monthly review, ang usually preferred nila dyan is yung vertical, yung one line.
Mhm. Ang galing ni Marie
Ayun lang
Chris.
naman.
Useful din yung mga ratios na yan pagka balak mong mag-invest sa stock market. Yan din ang ginagamit mong gauges.
Mhm. Thank you, Joel.
Okay, that's it for today, guys.
All right, that's it for today.
Matulog. Baka magla-live daw si Chris ng by 11. So, if someone can join the live, feel free to join. Pag hindi ako makatulog, mag-join na. Hindi tulog eh, no?
Kakanta mamaya si Marie Chris. Sayaw din.
Pang-banyo lang tong ko, yung boses ko.
Time po yung
Wala. Sabi niya kanina ni Chris, before mag-start na he will try to be on live by 11. So, abang-abang lang tayo guys kung magla-live siya.